There's something happening in the stock market that has defied every prediction, confounded every expert, and broken every historical pattern. While economists scream about recession, while inflation devours purchasing power, while geopolitical chaos erupts across the globe, the stock market keeps climbing month after month, quarter after quarter, reaching heights that should be mathematically impossible given current economic fundamentals. This isn't normal market behavior. This isn't rational investor sentiment. This is something entirely different, something that reveals the hidden mechanics of how modern markets actually function versus how we think they function. And understanding this difference isn't just academic curiosity, it's the key to grasping where we are in the largest financial experiment in human history. Right now, as I speak, the S&P 500 sits near all-time highs. While corporate earnings are stagnating, consumer debt is exploding, and real economic growth has flatlined. Traditional valuation metrics suggest stocks should be trading at half their current levels. Yet, here we are, watching markets defy gravity like a cartoon character who hasn't looked down yet. But here's what nobody's telling you. This isn't happening by accident. This isn't market euphoria or investor optimism. This is the deliberate result of policy decisions made over the past 15 years that have fundamentally altered how capital flows through the economy. We're not watching a stock market anymore. We're watching the world's largest wealth redistribution machine, engineered to transfer money from savers and workers to asset holders. And it's operating exactly as designed. In this video, I'm going to show you the three primary mechanisms driving this artificial market elevation. I'll reveal why traditional economic indicators no longer predict market direction, and I'll explain what this means for your money, your future, and the stability of the entire financial system. Because once you see how this machine actually works, you'll understand why the market keeps rising despite everything falling apart around it. The first mechanism is something economists call liquidity injection. But what it really means is money printing on a scale that dwarfs anything in human history. Since 2008, the Federal Reserve has expanded the money supply by over 400%. That's not 4% or 40%. That's 400%. 4 times more dollars exist today than existed 16 years ago. Where did all that money go? It didn't go to wages, which had been stagnant for decades. It didn't go to infrastructure or productive investment. It went directly into financial markets through a process most people don't understand, but that determines the price of every stock, bond, and asset in America. Here's how it works. The Federal Reserve creates money electronically, literally typing numbers into a computer. They use this newly created money to buy government bonds from banks. The banks receive cash in exchange for bonds, but they can't just hold that cash because cash pays no interest. So, they lend it out or invest it. Much of it flows directly into stock purchases, corporate bonds, and real estate. This isn't money that represents real economic value created somewhere in the economy. This is